While everyone was watching the S&P 500 scrape together a 9% return over the last 12 months, something else was happening quietly in the background. Emerging markets were up over 29%. That's not just outperformance, that's nearly tripling US stocks in a single year. So the question isn't whether emerging markets are worth paying attention to. The question is it already too late? In this video, we're going beyond the headlines. I'll break down everything you need to know before putting a single dollar into EM, walk you through your options to get started, and give you a concrete framework for deciding when to invest and how much. Let's get into it. Before we talk about emerging markets, let's address the elephant in the room. Staying parked exclusively in the S&P 500 might actually be one of the riskiest moves you can make right now. For a decade, we've been told that American tech is the only game in town. But what we're witnessing today looks a lot like a regime change, a fundamental shift in where the world's wealth is moving. Here's the problem. We like to think of the S&P 500 as a broad slice of the American economy, but it isn't, not anymore. It has quietly become a massive concentration bet. The top 10 stocks alone make up 41% of the entire index. That level of narrowness is historically unstable. If those 10 companies stumble, the whole index feels it. And think about what you're actually buying when you buy the S&P 500 today. You're not buying America. You're buying a high-priced ticket to the AI hype cycle. The Magnificent Seven have driven nearly half of all index gains, which leads investors to ask a very uncomfortable question. Are we looking at an AI bubble? While the US is stuck in a valuation bottleneck, emerging markets are offering a completely different equation. Let's look at the numbers. The S&P 500 is currently trading at a forward PE ratio of around 22 times. Emerging markets? They're sitting at a 35% discount, trading between 13 times and 15 times. That is a historically wide gap. You're essentially buying the same growth potential for a fraction of the US price. But here's the thing. Cheap alone means nothing. Cheap can stay cheap forever. The real engine driving this story is earnings. For 2026, while the US is projected to grow earnings by around 12%, emerging markets are accelerating to 17% EPS growth. That gap matters. So what's actually behind this? Think of it as a shift from digital alpha to physical alpha. In the US, we bet on the cloud. In emerging markets, they're building the ground, the literal physical infrastructure of the next global economy. We're watching a massive supply chain realignment unfold in real time. Global corporations are diversifying away from China to reduce geopolitical risk. And the winners of that shift? India, Vietnam, Mexico. Mexico just hit a record $41 billion in foreign direct investment as manufacturing relocates closer to the US border, a trend called friendshoring. Vietnam is seeing its highest factory relocation rates in 5 years, becoming the world's new workshop. And India is capturing what you might call the digital-physical hybrid, exploding growth in data centers and semiconductors. So what does all of this mean for you as an investor? The classic buy and hold the S&P strategy has quietly become a concentrated risk. Future gains will depend almost entirely on whether the Magnificent Seven can actually translate their AI ambitions into real profits. But does that mean capital is fleeing the US, that the system is broken? Not at all. In 2025, a staggering $1.55 trillion in foreign capital flowed into the US, and for good reason. American firms remain the uncontested global leaders in AI infrastructure, automation, and productivity. They have deep capital markets that fund massive R&D and buybacks. They have moats, real, durable, competitive advantages, and they've delivered earnings resilience even in a moderate growth environment. So this isn't about abandoning the US. It's about recognizing that a market correction, given current valuations, is looking increasingly likely. And when that happens, you don't want all your chips on one number. You're not selling America. You're diversifying into the regions that are physically building the infrastructure of the next global economy. You're trading a concentrated bet for a breadth play. So how should you go about it? And what should you buy? This story isn't EM versus US. It's about identifying which EM countries and sectors actually win in a fragmented world, while staying invested in the US. So here's the playbook. Step 1. Fix the concentration problem at home. Look at the S&P 500 equal weight index. By giving every company in the index an equal seat at the table, you capture the full breadth of the US economy, without betting everything on the top 10. Step 2. Go selective in emerging markets. Don't just buy a broad EM index. Most of them are dragged down by slow-moving, state-owned companies that never deliver. Instead, target specific profit nodes based on what you're trying to capture. Friendshoring play. Mexico is your pure play. It is the poster child for nearshoring. Foreign investment and exports directly tied to the relocation of US supply chains. AI supply chain play? While the US builds the software, Taiwan builds the hardware. It's the clearest listed market expression of the AI supply chain trade. And India is the broad winner for digital infrastructure, the data centers and compute power that AI actually runs on. Income and yield play? If you want valuation cushion and real returns rather than moonshot growth, look at Saudi Arabia, the UAE, and Brazil. These are real yield markets, built on carry, income, and stability. Quick note on the data you're seeing on screen. Forward PE figures can vary slightly, depending on the methodology used, but they give you a solid read on scale, direction, and relative value. We've looked at the upside, but if you've been in the game for more than 5 minutes, you already know there's no such thing as a guaranteed win. The biggest mistake investors make with emerging markets is assuming that cheap automatically means higher returns. It doesn't. Markets are cheap for a reason, and in most cases, what's missing is the catalyst. So, to help you time this right, I've built what I call a regime dashboard. 3 triggers that tell you when to move, when to accelerate, and when to pull back. Trigger 1. The yield ceiling. Watch the US 10-year Treasury yield. If it breaks above 4.8%, pull back on EM. High US risk-free rates pull cash into treasuries and away from emerging markets. They also put a crushing squeeze on high-debt countries. When yields spike, EM suffers. Trigger 2. The earnings reality check. If S&P 500 earnings revisions turn negative for 2 straight quarters, it's a signal that the AI productivity boom isn't hitting the bottom line. That's your cue. Accelerate your shift into EM value and defensive US sectors. Trigger 3. The dollar release valve. Keep a close eye on the US dollar index, the DXY. If it drops below 97, it's like a dam breaking. Capital floods into commodity-heavy regions and small-cap EM stocks. When that happens, increase your exposure. The goal here isn't to predict the future. It's to build a portfolio that doesn't need to. By following these triggers, you're not guessing. You're reacting to market gravity. When the dashboard flashes red, we don't hold on out of hope. We follow the data. Let's bring it home. You don't have to sell America to catch the emerging market wave. In fact, abandoning US stocks entirely would mean walking away from some of the most profitable companies ever built. But you do need to stop paying the concentration tax. You have 2 paths forward. Option 1, stay focused on the US, but swap the standard S&P 500 for the equal weight index. Same exposure, far less concentration risk. Option 2, move into emerging markets. But don't just buy the broad index. That's a trap full of laggards. If you want to profit from friendshoring and the AI supply chain build-out, be selective. Target the economies that are physically winning from the trade realignment. Latin America, India, and Southeast Asia. And always keep one eye on profitability and yield. Either way, watch the regime dashboard. Let the 10-year Treasury yield, the dollar index, and earnings revisions tell you when to lean into the US and when to shift weight toward the global stage. That's it for today. If this video gave you a new lens on your portfolio, hit that like button. It genuinely helps us grow the channel, and I want to hear from you. Which part of the emerging markets story sparked your interest the most? Drop it in the comments. Your answer might just shape our next episode. If you want to learn how to make money from macro trends and global shifts, subscribe. You won't want to miss what's coming next. See you in the next one.